Hello everybody. Today we are going to see IAS 40 investment property. IAS 40 defines investment property as land and building which is held to earn rentals or for capital appreciation or for both, and it is not for use by the entity nor is for sale in regular course of business. So basically when you're holding a property, either land or building, it could be classified as investment if you have rented it out and are getting rent income, or you are just holding it for capital appreciation, that is the value of the land and building is increasing. Now there are certain categories which you need to understand. Owner occupied property will be excluded from this definition as per IAS 40. If there is a multi-story building and part of the building is occupied by the entity and part is rented out, this building will be accounted in two different ways. The one which is occupied by the entity will be accounted for as per IAS 16 property, plant and equipment, and the floors which are rented out will come under the purview of IAS 40 investment property. Rented to subsidiary. If an entity has rented a building to its subsidiary, okay, then in the individual books of the entity, it will be recorded or recognized as investment property because it will be earning rentals from the subsidiary. But when you are consolidating the statement, it will be termed or it will be reclassified in the consolidated statement as property, plant and equipment. This is because the asset is used by the group as a whole and should be accounted for as property, plant and equipment. Now, how do you recognize and measure this investment? The initial measurement is at cost, and the subsequent measurement could be either the cost model, same as IAS 16 property, plant and equipment, where you are carrying forward the asset at cost with accumulated depreciation. So this investment will also be depreciated and the carrying amount would reflect in the SOFP. The second model is the fair value model. The asset is revalued at the end of each year and any gain or loss on revaluation will be recognized in SOPLs and not in OCI. There won't be any revaluation reserve for investment property. And one more thing that you need to remember is no depreciation will be charged if the investment property is being measured at fair value. Depreciation will be charged only under cost model and not the fair value model. So please remember, if you are using the fair value model for subsequent measurement of investment property, the asset will be revalued at the end of each year. The gain or loss arising on revaluation will be shown in SOPL and not OCI and the revaluation surplus, and there won't be any depreciation charged on this. Now let us look at an example to help you understand the cost model and the fair value model in a better way. An entity purchased a property for 2 million on 1st January 2010 as investment. The cost of land was estimated to be 1.5 million and the building was 0.5 million. The estimated useful life of the building is 25 years. How would the property be presented in the financial statement for the year ended 2010 if the company adopts the cost approach? Now let's look at the solution. The land will not be depreciated, but the building will be depreciated. Okay. SOPL will be charged with depreciation only for the building. The value of the building or the cost of the building was 0.5 million. Using straight line method, we will depreciate it for 25 years, which will come to $20,000. And in SOFP, you will recognize the property at $1.98 million. I hope this is clear. This accounting is very similar to the cost model used in property, plant and equipment IAS 16. Now let's look at an example where the fair value model is used. I'm taking the same example An entity purchased a property for 2 million on 1st January 2010 as investment. The cost of the land was estimated to be 1.5 million and the building was 0.5 million. The estimated useful life of the building is 25 years. How would the property be presented in the financial statements for the year ended 2010 if the value of the property has risen to 2.05 million? So now at the end of the year, 31st December, the property was revalued and the revalued amount is 2.05 million. So let's look at the solution here. Under fair value model, the property will not be depreciated. Whether it is land or building, the fair value model, the property will not be depreciated. SOPL will show a gain, that is the rise in the value of the property. The rise in the value of the property is $50,000, which will reflect as a gain in SOPL. And in SOFP, the property will be shown at fair value, that is $2.05 million. So you understand the difference between the cost model and the fair value. Under cost model, you will depreciate it. Under fair value, you will not depreciate it, but revalue the asset at the end of each year, and whatever is the gain or loss will be recognized in SOPL. Now let's look at this. Sometimes it may happen that currently you are using a property, plant and equipment, but now you have decided to rent out that property, plant and equipment. So how do you account for that? Let's take case number 1. The property is being valued at cost and it was now decided to transfer it to investment. Okay, so currently you are valuing the property at cost. It is under PPE IAS 16 and now you want to transfer it as investment property. So the cost model will be continued and the asset will be transferred or re-recognized as investment at the current carrying amount and continue to be depreciated. Okay, so if the property, plant and equipment is using a cost model and it wants to be transferred to investment, you will continue the cost model. That is, it will be transferred at the carrying amount plus depreciated. The second case, property is being valued using fair value model and now it is being transferred to investment. So in this case, before transferring it as investment, you will do a revaluation and any gain or loss will be reflected in the revaluation surplus before the transfer to investment property happens. Just before transferring it to as investment, you need to revalue it. Since it was recognized under IAS 16 PPE, you will treat the revaluation gain or loss in revaluation surplus. Now the other way around. Suppose it was an investment property and now you want to use it and recognize it under IAS 16 property, plant and equipment. Case number 1. Investment is being valued using cost model and now it is decided to transfer it under IAS 16 property, plant and equipment. So you will continue to use the cost model and recognize the property, plant and equipment as per IAS 16 at the current carrying amount and the accounting treatment will be the same as IAS 16. If it was the other way around, investment is being valued at using fair value model and now it is being transferred to asset, that is PPE, then just before the transfer you will do a revaluation. Any gain or loss arising on this investment property before transfer will be recognized in SOPL because they are using the fair value model, and fair value model says any gain or loss should be recognized in SOPL. So just before the transfer, if the investment property is being using the fair value model, you will revalue it. Any loss or gain on revaluation will be recognized in SOPL. Let's take an example to understand this better. An entity had rented out a building to a client which had a fair value of 5 million on 1st January 2012. The contract with the client ended on 30th June and the entity decided not to renew the contract and use the building for its administrative purpose. So here the rentals is going to stop and the entity is going to use the building itself. So now it will have to recognize it as investment property and recognize it under IAS 16 property, plant and equipment. The fair value on that day is 5.25 million and the remaining useful life of the building is 15 years. The amount will be recorded. What is the amount to be recorded in SOPL for the year ended 31st December 2012? Let's look at the solution. On 30th June 2012, when the transfer of investment property from investment property, it has to be revalued again. So on 1st January, the fair value was 5 million. At the end of the rental contract, it was revalued and it was revalued at 5.25 million. So there is a gain of 0.25 million. So this is revalued before you use it for under property, plant and equipment. Therefore, this revaluation gain will be recognized in SOPL. Depreciation will be charged from 1st July to 31st December because now it is recognized under property, plant and equipment IAS 16. So the same rules will apply for this property. So depreciation from July to December is 6 months straight line method. So the value of the building was 5.25 when we recognized it on 1st July for PPE. Depreciation 15 years. So we need to depreciate it for 6 months only. Therefore, half of it, and your depreciation would be 0.175 million, which will be charged to SOPL. Thank you so much. I hope you have understood this and it will help you to understand this concept and this accounting standard better.